do it. Yes, we can. All right, so the first thing what we're going to talk about today is in chapter 1. And I want to start off by talking about the difference between financial accounting and managerial accounting. Because they're not the same. Financial accounting, which is accounting 3, you're going to take that next semester, focuses on past performance. So we prepare financial statements such as income statements, balance sheets. Those are statements, financial statements that we use to evaluate past performance. So for example, on the income statement, what are we talking about? We're focusing on sales. Well, the income statement is not focusing on sales for next year, or 2 years from now, or 3 years from now. Now we could prepare what's called pro forma financial statements. Which might look at sales a year out, or 2 years out, or 3 years out. That's a projection. But traditionally when we talk about an income statement, we're talking about what was the performance for last year. And we're going to look at not just sales, but obviously what is our net income. Ultimately, how much money did the company make? And this information that's contained in the financial statements is used by third parties. Like who? Who would be an example of a third party that would use those financial statements? A board of trustees. The IRS. And usually we need to keep in mind that the standards that are set by GAAP. Everybody knows what GAAP is? Who could tell us? Right, generally accepted accounting principles. And the law that the IRS sets is different. Right? So, people always make jokes about having 2 sets of books. Well, yeah, generally you're going to have like at least 2 sets of books. Why? Because GAAP has certain requirements, but the IRS has other requirements. So what the IRS might say they will allow is not considered to be acceptable according to GAAP. So definitely the financial, when we talk about financial accounting, we're talking about people outside of the organization who heavily rely on these financial statements. Now, of course, obviously, managers and vice presidents and others within the company, of course, they want to see the income statement for the quarter, for the year. They want to see the balance sheet. They want to look at the statement of cash flows. But people outside of the organization rely on those financial statements. Investors, for example. So don't investors pore over the annual report of a particular company, trying to determine whether or not they should invest in that organization, whether or not they should buy stock in Merck Pharmaceuticals or Pfizer or Coca-Cola? They're trying to make some assessments. But what we're going to focus on this semester is managerial accounting, which doesn't focus on the past performance of the organization. What it does is focus on the information that we have available now to make decisions about the future. So information is power. As managers, we need information to make decisions. We need information to decide whether or not we're going to make the product or we're going to outsource the product. So in other words, either we're going to make it or we're going to buy it from somebody else. We need information to decide, well, what's going to happen if right now we have 6 product lines and then one of them we discontinue, we need to crunch the numbers and determine whether or not product line number 6, like let's say product line number 6 is shampoo, for example, whether or not that should be discontinued. And I know you're thinking, what does this guy know about shampoo, right? But you'd be surprised. So we need to make a decision. Should we discontinue the shampoo line? Well, how do we make that decision? And why do we care about that? Because you realize that the company has certain fixed costs. Fixed costs are those costs that don't vary with the production quantity. So whether we make 1 million units or we make 1 unit, whether we have 6 product lines or 5 product lines, the fixed costs don't change. So what would be an example of a fixed cost? Go ahead.
Lights.
Yes, lights could be, it could be a fixed cost if there's regular usage of electricity.
Okay.
Now we have to make a distinction though between those that are manufacturing costs and those that are non-manufacturing costs. Because if, let's say, you're producing less units in a given period, then your electric bill might be less. So if your equipment is running, let's say, currently 7 days a week, and then you cut back to 6 days a week, then your light bill will actually go down. So when we think about electricity, we need to make a distinction between electricity that is a part of manufacturing costs and that is electricity associated with non-manufacturing costs. So for the sales office, so that's the difference between a product cost and a non-product cost. The product costs are those that are tied to making the product. So our sales office, of course, they need electric to operate the computers and the printers and the lights, right? Those costs are tracked separately. But what we're trying to determine is, what is the standard cost to make this product? How do we know if we're being profitable? So what we want to do is assign as much of the cost as reasonable to a given product. And sometimes it becomes too tedious and sometimes even impossible to determine what the cost actually is, and those we classify as manufacturing overhead. So an example would be, let's say if we make desks and you need to use some glue. Well, how are we going to figure out, how are we going to be able to track how much glue we use for product A versus product B? It's going to be very difficult. But how do we know? Is it 3 ounces? Is it 2 ounces for this product or 1 ounce for that product? And then at the end of the day, well, how much does the glue really cost? So not every cost are we going to be able to assign to a particular product, but we try. So in some cases, it becomes too difficult and too time-consuming to establish what cost is related to that particular product. And so we don't do that. It doesn't mean that we can't figure out how much glue we use to make that desk, but then at the end of the day, what did we figure out? Okay, 3 cents worth of glue. Now what? I mean, what are we going to do? People have to spend a lot of time trying to calculate that and determine that. It doesn't make sense to do that. Questions?
Isn't it glue will be non-manufacturing cost, right?
Glue will be?
Glue will be non-manufacturing cost.
No, glue is going to be a manufacturing part of manufacturing overhead. Yeah, it's going to be a product cost, but
So what's considered to be the non-manufacturing? Because you said non-manufacturing.
right. So that's what I was telling you about the electricity, for example. So electricity for the sales office is a non-manufacturing cost. The salaries that we pay to the sales manager is a non-manufacturing cost. So these are all costs that are incurred after the product has been made, right? So the non-manufacturing costs are what you pay in commission to the salespeople. Advertising would be an example, right? This doesn't have anything to do with manufacturing the product. But before we go any further, are we clear on the difference between financial and managerial accounting? Everybody's good with that? All right, good. All right, so these are the manufacturing costs. There's 3 components. And I think this is a good visual because we need to understand these different terms. We need to understand these different costs. And there's a variety of different terms that you need to become familiar with. And some of them are interrelated, as you can see here. So you have your manufacturing costs. So manufacturing costs include these 3 components: direct materials, direct labor, and manufacturing overhead. That's your manufacturing cost. I hear somebody saying something. Who's? Okay, we're going to come to that. But so let's go through this one by one. Direct materials. So direct materials is a key manufacturing cost. In some cases, it's and sometimes we use the term raw materials. So the direct materials are the wood to make the desk. That's an example of direct materials. Or the screws that's used. Or the hinges, right? Those are examples of direct materials. It doesn't always mean raw materials. Raw materials, you think about things like what? Steel, gold, iron, right? It doesn't need to be, or it could be a raw material. It could be cotton. But direct materials refer to all the materials that we use to make the product. Questions about that? Who can give us some other examples of direct materials? Bless you.
Thank you. Steel,
What was that?
steel,
Yeah, steel would be an example of direct material.
wood, dough for donuts.
What was that?
Dough for donuts.
To make donuts.
Oh, for donuts. Yeah, definitely. Donuts, good example. The world runs on Dunkin', right? Is that what they say? Plastic, yep, absolutely.
Papers.
Paper, yeah. So all of those things could be direct materials. So we need to make a distinction. Then we look at direct labor. Now, direct labor refers to those costs that are associated with actually making the product. So it's the wages that we pay, for example, to people on the manufacturing assembly line. It's not, when we talk about direct labor, it's not the salary for the vice president or the CEO of the company. Of course, those are expenses that we want to track. Those are tracked as what we call selling, general, and administrative. And we're going to see that on the income statement. But what we want to focus on is what are the costs to actually make the product? And in this case, we're focusing on the labor that's associated with that. So just the labor associated with making the product. What about the salary that we pay the sales manager? What do you think? Is that direct labor?
No.
What about the salary that we pay the plant manager?
Yes.
Supervisor at the plant.
No.
It's different products.
Doesn't he coordinate what to do?
But isn't the product the plant, so.
So we sound like we have some difference of opinion there.
So does he have to like physically touch the materials to be assigned direct labor? Can he like manage people, tell them what to do and
Right, so this is the thing. So our challenge then is, if we have a plant manager, we need to assign some of those costs. But how do you decide, if you're paying the plant manager $100,000 a year, how do you decide how much of that person's salary is going to go towards the cost associated with making shampoo, or goes to the cost associated with making the donuts?
How long is
So-
that?
What was that?
How long is that in the year?
Right, so we need to allocate those costs. So those costs are going to be a part of manufacturing overhead. And then we're going to allocate them.
So a manager's salary is manufacturing overhead, not allocated.
Right. Because the workers on the assembly line or operating the equipment, that we know. We know that they're operating the equipment that's making the soda. Those three manufacturing costs we refer to as product costs, which is separate from the selling, general, and administrative. Selling, general, and administrative are those non-manufacturing costs. So we're going to have a corporate headquarters. We're going to have people that are accountants. How do we allocate that expense? We're going to have people who are accountants that work for the firm. We have people that are marketing managers. We can't forget about those. Those we capture as non-manufacturing costs. Those are the selling, general, and administrative. But for right now, we're focusing on the product costs. Questions about that? So you see the difference between the manufacturing costs and the non-manufacturing costs? Where, to the extent possible, we want to determine which are manufacturing costs and which are non-manufacturing costs. Why do you think that matters? Why is it so important to determine? Right, you want to know if the product line is profitable. So the non-manufacturing costs, to some extent you could argue that those are fixed costs. Because the salary of the CEO, the salary of the sales manager, the salary of the accountants, the rent on the corporate headquarters, the money that we spend on advertising, those costs are not going to vary with the production quantity. So we're not going to be influencing those when we say we're going to discontinue the shampoo line. What we want to find out is, in the manufacturing facility, where the costs are. And once we know what the costs are, then we could focus on reducing costs. Once we know how much our direct labor is versus our direct materials, then maybe we say, well, maybe we should automate. Then we maybe need to do an assessment and determine whether or not it makes sense to buy a piece of equipment instead of employing 1,257 laborers in the facility. So we need to know where the costs are coming from. Maybe we need to find a new plastic supplier. So we're going to talk a lot about cost. And we're going to try and influence the course where possible. So we're going to need, remember, we're talking about we need this information to make decisions. So we're going to be constantly evaluating our performance so that we could make these decisions. We're not going to just say, oh, we should switch suppliers. We need to understand what the impact is going to be. So for example, let's say the cost of plastic is, instead of 87 cents per ounce, it's 57 cents. So you say, oh, coach, I got it. We're going to switch to supplier B because 57 cents is less than 87 cents. But that doesn't tell the whole story. Because we need to understand, well, maybe the plastic is not the same quality. So if you're paying 57 cents, maybe you're getting a plastic that's of a lower quality. And if it is of a lower quality, then maybe it's going to cause us to have manufacturing overhead, a greater manufacturing overhead expense. Or maybe it's less per ounce, but maybe we need to use more of it. So maybe before we used 18,000 ounces, and now even though it's 57 cents an ounce, maybe now we need to use 22,000 ounces. So the whole focus of the course is around helping managers to make decisions and to make the right decisions. And that's why accounting, the role of accounting is so important. Because if you don't want it to be an arbitrary decision, you want it to be based on facts. So managers and executives rely tremendously on this information. Investors, they don't see this. They're not going to see the schedule of cost of goods manufactured. They don't see that, ever. Right? That's all internal. But we go through and prepare those schedules so that we have the information to make the right decisions. Now there's direct material and direct labor. But there's also indirect material and indirect labor. Now the difference is direct material, direct labor. When we say direct, it means that it's easily traceable to the product. So we know that we have these costs. We need to know the direct costs, those that we can easily trace, those that we can easily measure, that trace back to that particular product. But then there's some costs that it's going to be difficult to determine. Remember, we were talking about the glue. That would be an indirect material cost.
What is the commercial cost? I see the prime cost that I
Right. So the conversion cost,
conversion.
right, conversion. So the conversion costs are those costs that we incur to transform these direct materials, to transform the plastic or the cotton or the wood into a finished product. Those are conversion costs. So we have the steel or the plastic, whatever it is. How much is it going to take us to convert that into a product? And we're going to have different types of inventory that we're going to hold. So we have work in process. We have finished good. So the work in process are those partially completed items. We care about this. This is an asset, right? Inventory is an asset on the balance sheet. We care about this. Why? Because it's tying up cash. It's tying up working capital. That's money that if we have too much inventory, it's money that we have no access to. So we don't want to just have inventory for the sake of having inventory. Sure, it's an asset on our balance sheet, but you have to have the right amount of inventory to meet demand. So that's when we're evaluating our performance as an organization. We're going to look at how much inventory that we have. Now remember, as a company, very often we're borrowing the money. So if you have $100 million in inventory in an organization, for this company in the warehouse, and you might think, okay, but it's one of our assets, but what about if you're paying 10% interest to JP Morgan Chase? So there's a cost of capital. So it's not free. So the interest expense can be very significant. We want to have enough inventory on hand to meet demand of our customers. Does that answer your question?
Yes, I have second question. What is, I missed it. What is the working process, right? I said, the second one, what is it?
Finished goods.
Huh?
Finished goods.
Finished goods.
Right. So one of the things that you're going to see when we complete the schedule is you're going to see that we're going to look at what is the ending inventory for work in process, what is the beginning inventory, how much raw materials did we add into the process. So we talked about the product costs. The product costs are the costs that we're going to use to determine the cost of goods sold. The cost of goods sold is a line on the income statement. And it's going to have a significant impact on the profitability of the company. But before we could calculate the cost of goods sold, we need to calculate the cost of goods manufactured. And we're going to see that's why we have to complete this schedule so that we could calculate the cost of goods sold and then could use that, right, transfer that over into the line on the income statement. If you have your book, I want you to look at problem 16 in chapter 1. Problem 16, which is on page 65. so this is what the problem says. Everybody has it? Okay, if you don't have it, I'm going to read you the facts of the case. It says, Swift Company was organized on March 1st of the current year. After 5 months of startup losses, management had expected to earn a profit during August. Management was disappointed, however, when the income statement for August also showed a loss. And then it lists the income statement for the month of August for Swift Company. So we have sales of $450,000. It shows the operating expenses of $462,000. So in this case, the net operating loss for the month is $12,000. Then it says that after seeing the $12,000 loss for August, Swift's president stated, "I was sure we'd be profitable within 6 months. But our 6 months are up, and this loss for August is even worse than July's. I think it is time to start looking for someone to buy out the company's assets. If we don't, within a few months, there won't be any assets to sell. By the way, I don't see any reason to look for a new controller. We'll just limp along with Sam for the time being." The company's controller resigned a month ago. Sam, a new assistant in the controller's office, prepared the income statement on page 65. Sam had little experience in manufacturing operations. And then it lists the inventory balances at the beginning and at the end of August. So we have raw materials, work in process, and finished goods. All of those three are inventory. The president had asked us, right, as his consultant, has asked us to check over the income statement and make a recommendation as to whether the company should look for a buyer for its assets. The president suggests that we prepare a schedule of cost of goods manufactured for August and a new income statement. All right, so that's what we're going to do now. So we're going to do this one together, and then you guys are going to have a chance to do one on your own. All right? All right, so the first thing we're going to look at is direct materials. All right, so we need to go back to the information that we have here. So it tells us that we have, as of August 1st, raw materials of how much? 65,000?
165.
All right, but what's the inventory that we started with? But the 165 is what we purchased, $165,000 worth of raw material. But we need to start with the inventory that we have in hand. So we have raw materials of 8,000. And then we're going to add the purchases of raw materials. Which you said was 165,000, right?
And we need to minus.
All right, so this is 173,000. That's the raw materials that are available for use. So we start at the beginning of the month, on August 1st, we're trying to find out how much plastic we have. What is the value of the plastic? Now this is all this information we were talking about here, the manufacturing cost, is what's going into our schedule of cost of goods manufactured. So we're going to start off with direct materials, then we're going to look at direct labor, manufacturing overhead. So right now we're looking at direct materials. Our raw materials at the beginning of August are 8,000. Now what do we know about that 8,000? This beginning inventory, this is what this is, right? The beginning inventory of $8,000 for raw materials is the same as, right. I think I got that. So 15 of you were talking at the same time, but I think you said, right, that's the same as the ending inventory for July. Right, so as of the end of July is $8,000. So we have $8,000 worth of plastic. But then we get this order from Walmart. And we know, okay, we don't have enough plastic. So what we do is we purchase more plastic, and we purchase $165,000 worth of plastic. Now we have the $8,000 that we started with, $8,000 worth of plastic. We purchased $165,000 worth of plastic to give us a total plastic available, which we call materials available for use, of $173,000. Now, remember, this is on August 1st. Now what we're going to do is we're going to deduct the raw materials inventory as of August 31st. Which is what? 13,000, right? Everybody see that? That's just the information that, we're not calculating that, that's the information they gave us, which is $13,000. Now why do we care about that? What is it that we're trying to find out? What was, let's try that again, what was that?
How much we spend in raw
Well,
materials used?
Right, how much, go ahead, say it again.
Raw materials used?
Right, how much are the raw materials we actually used? So, if we had started the month with 18,000, we bought $165,000 worth of plastic, we have, at that point, $173,000 worth of plastic available to make product. 13,000 is left at the end of the month, right? So that gives us, what, 160,000? Which is the raw materials used in production. Does it make sense? So at the end of the month, we only had $13,000 left. $13,000 worth of plastic. We started with $8,000. We bought $165,000. Then we ended up with $173,000. But then at the end of the month, even after we made that big purchase, we had only $13,000 worth of plastic. That means that the rest of the plastic is what we use in production. That's the $160,000. What's your name?
Melissa.
Melissa, right? Everybody got what Melissa said? That's the raw materials used in production. Now this is the format that we're going to use for every schedule of cost of goods manufactured. All right, so follow me closely, because this is the way it's going to be what you're going to have to do on the exam and the homework. So if you have any questions, just stop me anytime. All right, so that's direct materials. So this we did, right? You guys follow me? Direct materials we did. Then we got to look at direct labor. So we did direct materials. Now we're going to do direct labor, which is, what do they tell us direct labor is? 70,000. So we don't, the 70,000, we don't need to calculate that. That's what they're telling us in the example. So you see that on page 65 in the income statement. It says direct labor cost is $70,000. And then manufacturing overhead. So we're up to here now. The manufacturing overhead is how much? So here we have this, direct materials, that's 1. 2, direct labor is 70,000. 3 is manufacturing overhead. And we said before, at the beginning of class, that these were the manufacturing costs. So that's what we're gonna put here is total manufacturing costs. We're gonna add these up to get the total manufacturing cost, which is what? How much? Right, 315,000. So we're adding this, 1, 2, 3. We're adding those to get, no. Yes. Yeah, these 3 to get 315,000. That's the total manufacturing cost. Are we done? No, not yet. We're not done yet. Now remember, we talked about different types of inventory. We said that we have raw materials. We said there's WIP, which is work in process. Sometimes we use the term work in progress, but it's the same thing. So WIP is partially finished goods. They're not completed yet. Because what we're interested in is the finished good. Ultimately, this desk, if it doesn't have the legs on yet, how can we sell that? So we're interested in the distinction. The partially finished goods, which is the work in progress, work in process, is an asset for the company. So that's an important distinction. At that point, those costs, okay, follow me here, those costs are actually assets, right? The cost of the raw material is actually an asset. We don't recognize it as an expense, right? These product costs, until, I think I heard you say it, right, until it's sold. Very important point. Everybody's clear on that? So, we buy raw materials. Now we're going to use those raw materials to make a product. When we purchase the raw materials, we could buy it with cash. Let's say we buy it with cash. The raw materials, we're actually going to debit raw materials and credit cash for the $165,000. Everybody follow? So we're going to write a check for $165,000 to purchase the plastic, right? To purchase that plastic. We're going to debit raw materials, which is an asset for us, and then we're going to credit cash for the $165,000 because cash is going down, right? Our cash is going down, decreasing, and our raw materials, our inventory of raw materials is going up. And you know, debits have always got to equal credits, right? Right? You guys got that, right? Crystal, you sure? Don't? You got to know that. So, with the raw materials, it's true. It's a cost that we're going to incur to make the product, but at the time that we purchase it, we record it as an asset. But not until after we sell the product do we recognize it as an expense. So that's the difference between the product cost and the period cost. Those product costs, we don't expense them. The product costs, we don't expense them at the time that they're incurred. The product costs are not expensed at the time that they're incurred. They're expensed at the time that the product is sold. Period costs are just the opposite. Period costs, at the time that you incur them, they're expensed. So at the time that you pay to Melissa and Odalis, the time that you pay them their salary, they're our accountants, and they're getting paid, I decided that they're going to get paid $150,000 a year. Is that okay? I mean, you can negotiate with me. Their salary is a period cost. We expense that. That's an expense, a selling, general, and administrative expense. It's a non-manufacturing cost. But we also have these product costs. The product costs, we're gonna document those costs, we're gonna track those costs, but we don't expense them until the product is sold. And that's what we call cost of goods sold. So, questions? Can we go on? So you'll see these terms, and I do think that this is kind of helpful to visualize it because these terms, they're interrelated. They are definitely interrelated. You're saying, well, this is that, and yes, right? So these are manufacturing costs, and these three manufacturing costs collectively are considered to be product costs. Product costs are not the same as period costs. The combination of direct materials and direct labor is prime cost. Direct labor and manufacturing overhead is conversion cost. Those costs to transform the raw materials into a product are considered to be conversion costs. All right, so we're not done yet. So far we have total manufacturing costs of $315,000. Now, there's something that we didn't capture yet. What did we leave out so far? what are we missing? So we have the total manufacturing cost. Is $315,000. Everybody got that so far? But we got to add something. What do we need to add? No, not yet. Right. What about the work in process? Remember I said we don't want to lose sight of the work in process. That's money that we have tied up in desks without legs. So we need to capture that here. So we're going to add in the work in process inventory. WIP. Very often we refer to it as WIP. So we add in the work in process inventory that we had at the beginning of the month. You follow me? So at the beginning of the month, you walk into the factory on August 1st, there's desks without legs. In this scenario, we know that that's worth $16,000. So we need to capture that. But then what? Then we need to find out, well, if we added the work in process at the beginning of the month, right? The value of the work in process inventory at the beginning of the month, then we need to subtract the work in process inventory at the end of the month. Which is how much? 21,000. And that gives us the cost of goods manufactured. All right, let it sink in. You guys getting this? So everybody knows what just happened? No, we're not done yet. But we're done with this part. This is the cost of goods manufactured schedule, right? But the reason why we calculate this is ultimately so we can figure out what are the cost of goods sold. So this is the cost of goods manufactured schedule. So that part is done. So yes, Crystal, that part is done. You're right. That's the schedule of cost of goods manufactured. So who wants to explain the schedule? Who wants to explain the process from start to finish? Somebody? Anybody? Do you want me to explain it? You sure? All right. So let's start here with our manufacturing costs. Direct materials, direct labor, manufacturing overhead. Those are our manufacturing costs. That's what we have here. That's what we're looking at here, is our manufacturing cost. Direct materials, direct labor, manufacturing overhead. And that's what we have. Direct materials, direct labor, manufacturing overhead. these numbers, direct labor and manufacturing overhead, in this scenario, it's given to us. So that's basically like a plug number. But to get to the raw materials used in production, we have to go through a number of calculations. Right? We're going to need to go through a couple of iterations here to get to the 160,000. So we're looking at direct materials. We start off with the $8,000. So we come in at the beginning of the month, we have $8,000 worth of plastic. All right, so we write that down. Raw materials inventory as of August 1st is $8,000. Then what do? We purchase more plastic. Remember I said we got that order from Walmart? We realized we don't have enough plastic on hand. So we're going to purchase raw materials. We said that we're purchasing $165,000 worth of raw materials. So we add that to the $8,000 that we already have. That means that if we started with $8,000 and we purchased $165,000, now we have raw materials of $173,000 available to us to make product. Does that make sense? We had $8,000, we purchased $165,000 worth of plastic. Now we have $173,000 worth of plastic. But we need to find out how much of the plastic we actually use that month. So the way that we do that is we look at how much plastic is left at the end of the month. We started with $8,000, we bought $165,000. How much is actually left? In this case, we're told that we have $13,000 worth of plastic. So if we have $13,000 worth of plastic left, out of the $173,000 worth of plastic, that means that we used $160,000 worth of plastic that month. Does that make sense? So we're looking at what we started with, what we purchased, how much was available, what was left at the end of the month, and if that's what's left, that means that that's how much we used, $160,000 worth of plastic. So that's the same format you need to use when you're going to prepare the schedule. And when you do that on the exam, same thing. You write it out this way. You have your direct materials, raw materials inventory at the beginning. You add your purchases. That gives us the raw materials available for use. Then you're going to deduct the raw materials you had at the end of the month. That gives us the raw materials used in production. Then to that you add the direct labor. Then you add the manufacturing overhead. And that gives us the total manufacturing cost. That's the total manufacturing cost. And that's what we put up here, the total manufacturing cost. But then, we said we didn't capture everything yet. Mind you, we're just talking about product costs now. We're not talking about period costs. We're just talking about product costs. We said, well, wait a minute. You know, at the beginning of the month, here we were focusing, remember, we're just focusing on raw materials here. We're just focusing on the plastic. But what about the product that's not completely finished? What about when we walked in that month, we had all the plastic components, but they're not assembled? Or maybe they're partially assembled. We need to capture that. So that's the work in process inventory at the beginning of the month. So we need to add that in. Because ultimately what we're trying to figure out is the cost of goods manufactured. What was the cost of goods manufactured? Well, these goods were manufactured. It's just that we didn't finish them. But we used plastic to make this. It's just that we didn't complete it. And we used labor. So you see why we're going back there and saying, well, what about the partially finished goods? Because up here we just focus on the raw materials. But what about the partially finished goods? Because some of this labor was used to partially make the product. Some of the manufacturing overhead, those that are the indirect costs, manufacturing overhead is the indirect costs. Those that are what? Not easily traceable. Remember, we said these direct materials, direct labor, are those that are easily traceable to the product. But certainly there's indirect materials, and there's indirect labor that we classify as manufacturing overhead. So we incurred those costs to make this product, even though it's not fully assembled. So at the beginning of the month, we had $16,000 worth of partially completed product. So from that, we deduct, well, how much partially completed products did we then have at the end of the month? Which in this case is $21,000. And that means the cost of goods manufactured in this case is $310,000. To see how this is going to show up on the income statement. So what we're going to do now is we're going to prepare a short income statement. All right, so everybody's got this? All right, so I'm going to erase this. All right, so now we're going to look at the income statement. So remember, I told you that we need to calculate the cost of goods manufactured so that we could determine the cost of goods sold. So that's what I'm going to show you now. This is the income statement. All right, so what are the sales? What does it tell us? It tells us how much sales are. What does it tell us in this scenario our sales are? $450,000 for the month. That's not so bad. Right? What do you think? What if it was James' company? What do you think? $450,000 a month? You know? That's not enough to be a shot caller? that's a nice amount. All right. So follow me here. From sales, we have to subtract the cost of goods sold. Did they tell us how much the cost of goods sold is? No, right? All right, so we gotta calculate that. So this is what we do. We take the finished goods inventory, the beginning finished goods inventory, and how much is that as of August 1st?
40,000.
So this is our beginning inventory of finished goods on August 1st. That is 40,000. Now, that's our finished good inventory. Now what we do is we take this. Remember, we're trying to figure out what is the cost of goods sold. So we take our beginning finished good. We take the beginning finished good of 40,000, and to that, we're going to add the cost of goods manufactured. Because remember now what we're doing is we're at the point where we're going to expense those costs. These are the product costs. Remember, we're keeping track of our product costs, but we said we're not going to expense them until the product is sold. So now we're doing our income statement. We have sales for the month of $450,000. Now we need to figure out what is the cost of the goods that we sold here. So this is the way we calculate it. To calculate the cost of goods sold, we take the finished good inventory at the beginning of the month. We add the cost of goods manufactured, which is $310,000. That gives us $350,000, which is what? What is that? What is that $350,000?
Available for sale.
I don't think I'm hearing it somewhere. I think you said it.
Available for sale.
Right. That's the goods available for sale. Is $350,000. Then what's next?
Deduct finished goods.
Yes, I heard you say deduct finished goods. You said it. Yes, go ahead. Elena?
Yeah.
So deduct the finished goods, what?
Ending inventory.
Right. So deduct finished goods ending inventory as of August 31st. And how much is that?
60,000.
So they tell us, we're not calculating that, they tell us that the ending finished good inventory is $60,000. Actually, let's move this over here. So we subtract we get from the goods available for sale, we deduct the finished goods of 60,000, we get 290,000. From the sales is what? 160,000 is our gross margin. So what is this number? What is this? Right? That's the cost of goods sold. That's what we're calculating here. So the cost of goods sold is 290,000. They told us $450,000 is our sales. We don't know what the cost of goods sold is, right? They didn't tell us that. So we got to calculate that. We start with our finished good inventory on August 1st. They tell us it's $40,000. Then we're going to add the cost of goods manufactured. That's what we did here. Direct materials, direct labor, manufacturing overhead, and we got to the cost of goods manufactured. Now we get a chance to use that. We add that here, the $310,000. So we add the finished good at the beginning to the cost of goods manufactured, and that gives us, we said, the cost of goods, the goods available for sale, which is the $350,000. Then we deduct the ending finished good inventory, which is $60,000. And that gives us the cost of goods sold. So we see cost of goods manufactured and then cost of goods sold. You see the numbers, they're not the same, right? The cost of goods sold in this case is $290,000. And here, the cost of goods manufactured is $310,000. Why is that? Who could explain why that is? He said, wait a minute. He said, come on, coach, give me a break here. Let's see. Go slow. Cost of goods manufactured, right? $310,000. But then, when we put together our income statement, we need to know what are the costs of goods sold. You're telling me it's $290,000. We didn't sell everything. We didn't sell everything. We still have significant costs, but here, what are we trying to do? What does the matching principle tell us? The costs associated with the sale of those products have got to be matched up, right? Isn't that what we've been doing all along? Remember, we said it's very important to note that these are product costs, not period costs. Period costs are what? What's the example of a period cost? Mackenzie. Rent. Right? So the rent of what though? The rent of which building? So sales, administrative, but what about if it's the rent for the manufacturing facility? If you shut down the plant, do you still have to pay the rent?
The rest of the month, probably, the rest of the year.
Or at least
Right, you still have to pay the rent. So in that case, that's a fixed cost. The rent is a fixed cost. So even if we shut down the plant, does everybody go home? That's one of the challenges in manufacturing. That's one of the real issues that manufacturers have and why they struggle to be profitable, like for example in the auto industry, is because they have significant fixed costs. And even if you're not making any cars, you still have those fixed costs. They don't go away. You wish they could go away, right? You wish you could just say, no, I'm not making any cars. And then you wouldn't have any fixed costs. Now, your electric that you used to make the cars, right, to run the manufacturing equipment, that's going to go down. Your electric bill is going to go down. The cost that for the labor, right, what were you paying the workers, that's going to go away. But you're still going to have to pay your property tax. You're still going to have to pay your rent. You're still going to have to pay your senior executives. Unless the whole company just went out of business, then that expense would go away too. But those are period costs. Now a period cost, now stay focused here. A period cost can be fixed or variable. Right? And the same for a product cost. So fixed cost, total fixed cost do not vary with the production quantity. Now in the past, I asked on exams, what is a fixed cost? And students write a cost that's fixed. Well, yes, it is a cost that's fixed, that's true, but the key is that total fixed costs are not going to vary with the production quantity, which means that if you make 10 million units, your fixed costs, let's say, are $100 million. And if you make 1 unit, your fixed costs are still $100 million. That's your total fixed cost that we're talking about. Now your variable costs are costs that do change with the production quantity, which is that plastic. So plastic is a product cost that varies with the production quantity. So in other words, the more units you produce, the more plastic you're going to use. So as the production quantity increases, the total variable cost is going to increase. And the reason I emphasize the total variable cost is because the unit variable cost is going to stay the same, which means 1 ounce of plastic is, let's say, 32 cents. If you make 1 million units, a unit, 1 ounce of plastic is still going to be 32 cents. Unless you might get a volume discount. You might say, well, wait a minute, now we're making 100 million units, right? We're going to need 100 million ounces, let's say. You need to give us a discount. But let's assume that there is no volume discount. So the unit variable cost is still 32 cents per ounce of plastic, but the total variable cost is going to increase. So 1 unit is going to cost us 32 cents. 10 units is going to cost us $3.20 worth of plastic. So the total variable cost is going to increase as the production quantity increases. The same with, for another variable cost would be electricity. Not the electricity for the corporate headquarters, but the electricity used to run the manufacturing equipment. If you're running the manufacturing equipment 1 day a week, you're going to use a certain amount of electricity. Let's say 100,000 kilowatts. You wouldn't want to get an electric bill at your house for 100,000 kilowatts, right? But if you're running this business and you have monthly sales of $450,000, hopefully we'll still have profit at the end of the month. But at a minimum, we still want to be able to pay our accountants, right? Questions? So we have product cost and period cost. The period costs are those non-manufacturing costs. Those are not associated with making the product. Those costs can be variable or fixed. The product cost could also be variable and fixed. Does everybody see that? So there's a variety of terms that we need to internalize. I want to make sure that everybody, that we're all on the same page. Go ahead.
So salaries are not period costs, salaries for like our labor?
Okay, so we have to say, is the salaries for the workers in the factory, or is it the salaries for the managers in corporate headquarters?
Factory.
So for the factory, then that's direct labor. That's a product cost. The period cost would be the salaries of the executives. Questions? It's all right. You could ask questions. Think about it. So both of them could be, and this is one of our one of our challenges is to classify these courses. That's what we're doing. That's why we need to get these terms down, because what we're doing is we're classifying these different courses. So you need to know the difference between the product course and the period course, between fixed course and variable course, between manufacturing course and non-manufacturing course. We talked about the manufacturing overhead. That's where we capture the indirect materials and indirect labor. Are we clear on that? So, for example, we have a janitor that works in the manufacturing facility. So somebody's got to still clean the floors, the windows, the bathrooms in the manufacturing facility. So we hire a group of people, the cleaning people, the janitors. That's a product course. But it's what we would classify as indirect labor as part of our manufacturing overhead. We can't forget about that, that we're paying all these people to perform these services that are directly related to manufacturing the product. If we weren't manufacturing the product, they wouldn't have to do that. Now, the cleaning people that we have at the sales office, that we have in the our design center, in our advertising office, in the brand management office, if we have cleaning people there, well, those are period course, because that has nothing to do with manufacturing the product. It's important. It's a selling general administrative expense. It's a non-manufacturing course, and we definitely need to keep track of that. But we're interested, what we're focusing on now is the manufacturing course. What is it cost to manufacture the product? So if we have, but remember we said, well, how do I know? We got 6 people here that clean the bathrooms, clean the floors, but how do we allocate for product A, product B, and we're going to get to how we actually allocate that later on, but the point is, right now, we've got to focus on classifying those costs. So we say, well, wait a minute, I don't know if this is, how do you say, oh, the guy mopped the floor here, oh, so that's part of shampoo. Oh, this is part of, what else do we make at this company?
Conditions.
Dishes too?
Conditioner.
Oh, conditioner, there you go. That's good. Because it's very likely you're going to get an A in this class. So we have our shampoo, we have our conditioner, but remember we said that there are some costs that are traceable, that are easy to trace and track back to a particular product. Like the raw materials. We say, well, this is how much plastic we use to make this product. Well, maybe this product, we don't even use plastic. So we know we could track that easily. That's traceable, easily traceable. That's direct materials, right? That would be part of direct materials. Or the labor for somebody who's working on a particular manufacturing line as part of the production process. But the janitors, how do we know? And even the plant manager, well, the plant manager, of course, that's an expense. He's managing the whole manufacturing facility. He doesn't make as much as the accountants, right? But, well, who knows? Maybe he does. Maybe she does. I don't know. But we got to capture that cost. We don't know if it's for the conditioner, how to allocate it at this point, right? But we know we need to capture that. So that's part of manufacturing overhead. That's indirect labor. So the direct labor, we know the guy's sitting there operating the machine all day long. Well, he's making shampoo. So we could allocate those costs easily as direct labor. But for shared costs like that, there's the plant manager or the janitors or other shared expenses, it's difficult to assign the cost. So those are considered to be manufacturing overhead. And the manufacturing overhead could be significant. I'm not saying that it's not significant. It could be significant, but it's just it's difficult to assign it to a particular product. So we capture that here. And in this case, as we said, $85,000. That could be $85 million. Just questions? So what do you think? You guys still excited? Yes! We can do it! Yes, we can! Yeah, you're gonna do it. And this is just a process. This is just, you just gotta follow this format. And there's some critical thinking involved. You know, like we were talking about, well, you start off with the beginning inventory and add that, and then you subtract the ending inventory, right? So that's, we gotta, we're not always gonna have perfect information. So we don't know how much materials were used. Well, you don't know how much was used. Maybe you weren't keeping track, but you know how much you started with. You know how much you started with, and then you know how much you're left with. So the rest of it, I'm going to assume that you used it as part of the manufacturing process. Unless somebody went home with 10,000 ounces of plastic. Now, if it was gold, maybe, probably they did. But plastic, probably this probably was just used as part of the manufacturing process. All right, so let me tell you which schedule of cost of goods manufactured you guys are going to try. Let's see, so that one was problem 16 from chapter 1. And the one that I want you guys to do is problem 21, which is on page 68. So what you need to do is prepare the schedule of cost of goods manufactured and the cost of goods section for the company's income statement, just the way that we did it here. So this one is, the company's name is Superior Company. Yes, go ahead.
We published the income statement? Have we done this income statement?
No, we're not.
Yes,
You're right. We didn't finish. Thank you. So we have 160,000 is the gross margin, and then we're going to subtract the selling, general, and administrative, which we'll abbreviate as SG&A, which is how much in this case? What do they tell us? $142,000. And that gives us $18,000. That's the net operating income.
What problem do you want to do right now?
21.
So, can we do this on the blackboard?
You're going to post it to Blackboard
Okay.
when you're done. And we're going to talk about it next class. All right, so it's problem 21. The name of the company is Superior Company. And it's starts on page 68 and goes through the top of page 69. Also, we're going to do these exercises, which is in chapter 1, exercise 10. So exercise 10, you have to classify the cost as variable or fixed, and whether it's selling general and administrative or a product cost. So selling general and administrative is a period cost, right? So the cost, they give some examples like advertising, like we talked about, is 10 costs. You have to say whether or not the cost is variable or fixed, and also whether or not it's a period cost or a product cost.
That is exercise to page of that on.
62. That's at the bottom of page 62.